Good morning to traders in Asia. I'm your host Eric for today's Global Market Focus, which is currently trading around 159.40 against the US dollar. To understand where it's heading, we need to unpack the key drivers that are keeping it in a weak but stable range, just shy of the 160 level that triggered intervention in 2024. The biggest news this week came from the Bank of Japan, BoJ's monetary policy meeting on Tuesday, April 28, which set the tone for the yen's near-term trajectory. As expected, the BoJ voted 6-3 to keep its short-term interest rate target unchanged at 0.75%, marking the third consecutive meeting where it has held rates steady since starting its hiking cycle in December 2025. Notably, 3 policy committee members proposed hiking rates to 1%, but their proposal failed to gain majority support, a sign of growing division within the central bank about how to balance inflation, economic growth, and yen stability. The BoJ also increased its 2026 fiscal year core CPI forecast to around 2.3%, up from 1.9% previously, signaling more confidence in sustained mild inflation. So, why is the yen holding steady near 159.40 instead of depreciating further? The answer lies in intervention expectations, not delayed rate hikes. Contrary to some market speculation, delaying rate hikes actually puts downward pressure on the yen by widening the U.S. expectation that Japanese authorities will intervene if it breaks above 160, as they did in 2024 when they spent nearly 15.3 trillion yen to defend the currency. Let's break down the key levels and near-term forecast for USD of JPY current price, 159.40. Key support, 158.80, near-term, tested after Tuesday's BoJ decision, 157.50, major support, last tested in mid-April. Key resistance, 159.90, intervention threshold, just below 160, 160.50, critical resistance, a break above here would likely trigger official intervention. Near-term forecast, next 1 to 2 weeks we expect the yen to remain in a tight range of 158.50 to 159.90. With a mild bearish tilt but limited downside due to intervention fears. The BoJ's hawkish pause, maintaining rates but hinting at a possible 25 basis point hike in June, will keep the yen from depreciating sharply. If the US dollar weakens on softer economic data, we could see US dollar to Japanese yen pull back to 158.00. If US data is strong, or if BoJ rhetoric turns more dovish, we could test the 159.90 resistance, but a break above 106. Cutting rates later this year, the US-Japan rate gap will narrow, providing more support for the yen. Part 2. Japanese stock market forecast, Nikkei 225, April 29, 2026. Now, let's turn to the Japanese stock market, which made history earlier this month when the Nikkei 225 index crossed the 60,000 point mark for the first time, hitting an intraday high of 60,634.66 on April 28 before pulling back to close at 59,917.46, a 1.02% decline on the day. This rally is not a bubble. It's driven by a confluence of strong fundamentals, policy support, and wide foreign capital inflows, making it a structural bull market rather than a short-term surge. Let's start with the key drivers behind the Nikkei 225's rally. First, corporate earnings strength. Japanese Sanshougang listed companies reported a third consecutive year of 32% plus net profit growth in the 2025 fiscal year, ending March 2026, with return on equity, ROE, rising to nearly 11%, up from 8% in 2023. This is thanks to structural reforms, including the Tokyo Stock Exchange's capital efficiency reform, that's pushing companies to optimize balance sheets and increase shareholder returns. Export-focused sectors like increase since 2021, while nominal cash wages have grown for 50 consecutive months. This is critical because it boosts consumer confidence and domestic demand, providing a second pillar of support for the economy and stock market, beyond exports. Third, foreign capital inflows. After a net outflow of 7.37 trillion yen in March, due to Middle East tensions, foreign investors have returned in force in April, with net buys of 2.96 trillion yen in the first week alone. Foreign investors account for about 30% of Nikkei 225 trading volume, and their return has been a key catalyst for the index breakthrough above 60,000. Importantly, the yen's weak but stable status has given foreign investors confidence. They no longer fear sharp yen appreciation that would erode their dollar-denominated returns. Fourth, policy support and bullish institutional outlooks. The Japanese government's Takemichi economics continues to provide fiscal stimulus, with a 6.4 trillion yen plan to support semiconductors, AI, and defense sectors. Meanwhile, major institutions like JPY have raised their year-end target for the Nikkei 225 from 61,000 to 70,000, citing strong corporate earnings and AI-driven growth. AI-related stocks now account for 45% of the Nikkei 225's weight. Key levels and near-term forecast for Nikkei 225 current level. April 28, 000, psychological resistance. Near-term forecast. Next 1 to 2 weeks we expect the Nikkei 225 to consolidate between 59,500 and 60,800, with a bullish bias. The pullback from 60,634 is a healthy correction, not a reversal. Corporate earnings remain strong, and foreign inflows are likely to continue as Middle East tensions ease. If the index holds above 59,700, we could see another attempt to break above 60,634 and test 61,000. A break below 59,500 would signal a deeper correction to 58,500, but that's less likely given the strong fundamentals. Longer-term outlook. Next 3 to 6 months the structural bull market is likely to continue, with the Nikkei 225 on track to reach JPY's 70,000 year-end target. Key catalysts will be ongoing corporate earnings strength, the BoJ's potential June rate hike, which would signal confidence in the economy, and continued foreign capital inflows. Risks include a sharp yen appreciation, triggered by intervention or faster than expected BoJ hikes, a global economic slowdown, or a resurgence in Middle East tensions. The link between yen and Nikkei 225, a paradigm shift. Before we move on, it's critical to understand the evolving relationship between the yen and the Nikkei 225. Of intervention and higher import costs, which hurts domestic-focused companies. If it appreciates too much, below 155, it erodes export profits. The current range of 158 to 160 is the sweet spot, stable enough to keep foreign investors confident, while weak enough to support export earnings. This exchange rate stability premium is a key driver of the current stock market rally. Risk and money management, non-negotiable. Before we move on, let's talk about risk management. This is the most important part of any trading plan, and we never skip it here. For traders looking to trade US dollar to Japanese yen or Nikkei 225, first, max risk per trade, 1% of your trading capital. That means if you have $10,000 in your account, you should only risk $100 per trade. This keeps you in the game even if a few setups fail. For US dollar to Japanese yen traders, avoid trading around the 159.90 to 160.00 intervention zone unless you have clear confirmation of a break or rejection. For Nikkei 225 traders, don't chase the rally. Wait for pullbacks to key support levels, 59,500 to 59,700, for long setups. Also, keep an eye on yen moves. Any sharp appreciation above 158 could trigger a temporary Nikkei pullback. Key risk factors to monitor. BoJ policy announcements, US economic data, which impacts the effectively. For US dollar to Japanese yen, only enter trades when the pair tests key support or resistance levels, 158.80, 159.90, with candle confirmation, pin bars, engulfing patterns, or rejection wicks. If US dollar to Japanese yen breaks above 160.00 and holds, avoid shorting. If it breaks below 158.80, consider short setups with a stop above 159.50 for Nikkei 225. Prioritize long setups on pullbacks to 59,500 to 59,700 with confirmation. If the index breaks above 60,634 and closes above that level, consider aggressive long setups with a stop below 60,000. Avoid shorting unless the index breaks below 59,500 with confirmation. This bull market has strong momentum, and counter trades are high risk. One more thing, market conditions can change quickly. Keep an eye on BoJ commentary. Any hints about June rate hikes or yen intervention can move both assets. Also, monitor US Fed policy signals, as changes in US rates will impact the US-Japan rate gap and the yen, which in turn affects the Nikkei 225. That wraps up our forecast for the Japanese yen and Japanese stock market. Nikkei 225 guaranteed, but following these rules and managing your risk will give you the best chance of success. Thank you for joining us today. Whether you're a new trader or a seasoned pro, we hope this analysis helps you make informed trading decisions. Tune in tomorrow for our next global market focus. And as always, trade smart, manage your risk, and we'll see you in the markets.